we started talking about, well, we did all that, we did that, the storage unit. And so each account, or we call them, the grouping is called the chart of accounts. The account will very clearly highlight what information is going to be in that account. So we have some accounts we already know about. We know about the account called cash. We know about the account called accounts receivable. Remember us talking about these types of accounts are called assets. We also talked about some accounts that are liabilities, such as accounts payable or notes payable. We talked about some accounts that are expenses, like rent expense, supplies expense. Then we also talked about some equity accounts, like owner's capital. Remember that? Withdrawals. So those are various types of accounts. And the grouping of all those accounts for one type of company that a company chooses to list all their various transactions in is called the chart of accounts. In manual accounting systems, each account is kept on a separate piece of paper or a card in a big book. So you have a big book, you flip it, the first one might say cash. Usually you keep all your assets together. The second page would be accounts receivable. The third page might be automobiles for assets. The fourth page might be various types of equipment. Each account is on a separate page in the old system, the manual accounting system. But in computerized systems, thank God we have them, we call the whole group of account the general ledger, or you can call it the ledger. But the general ledger houses all the accounts that companies use in that particular line of work. Each company is going to have a different type of chart of accounts. So for example, if I run a trucking company, I'm going to have trucks, I'm going to have all kinds of maintenance, I'm going to have maybe on hand various different parts to the trucks to keep them up and running. I'm going to have truckers, I'm going to have different types of accounts so I can classify the transactions I'm going to handle. In an accounting business, I'm not going to have trucks. I'm not going to have a lot of maintenance. I might have copy machine maintenance, repairs, but apart from that, I really have revenues from one source, and I might have rent expense and salaries and some other things. So each type of business is really going to determine what type of accounts that company wants to work with. The chart of accounts is a table of contents for the ledger. It lists all the account titles and the numbers that have been assigned to each account. It usually lists the accounts in the order in which they appear in the ledger. So we'll talk about that as we get closer to it. Well, here's an example. Generally, assets that are part of the balance sheet, assets are listed first. And do you see how all of the assets are listed as 100 numbers? You generally list all of your assets in one grouping of numbers. Next, we have liabilities. In this case, they're listed in the 200 number range. So we've got in the liabilities, you see a listing of all of those liabilities together. Here we only have 4: notes payable, accounts payable, unearned revenue, and wages payable. So they're all listed in the numbers 2. In the number 3s, we have all of our equity accounts that we had talked about when we were doing that owner's equity statement. We've got the owner's capital, the withdrawal, and something we're going to talk about called the income summary account. And then 4s, do you see how there's only one revenue we have here? It's service revenues, and it's in the 400 series. Then last, all of our expenses are in the 500 series. So the chart of accounts lists by groupings all the accounts that we use for this business. These are the only accounts a company can use because they're listed in their chart of accounts. Something accountants use to make to make transactions real tangible and visible to their in processing is something called a T account. I use T accounts still when I'm trying to figure things out. A T account is just a manner in which we analyze various accounts. The three parts of a T account include the title. Really important you have a title, guys, because then you don't know what you're dealing with. The title is important, which helps us understand, is it an asset, is it a liability, or is it part of the owner's equity account? Then, every T account has two sides. One side's called the debit, and one side is called the credit. Now, as you see in this T account right here, we have it listed that it's cash. We know cash is what type of account? Asset. The DR stands for debit and the CR stands for credit. A debit only means left. That's all it means, the left-hand side of an equation. The credit only means right, the right side of the account. So don't think of a debit as up and a credit as down, or for this purpose, a debit just means left and a credit just means right. Now, many of you might be thinking, oh, but when I go to a bank and I give them a deposit, they say we're crediting your account, which means an increase. Anyone thought of that before? But they're crediting that specific account, your account. So hang in there with me. Credit only means right. Debit only means left. If you look here on this specific account for cash, you see some numbers on the debit side and you see some numbers on the credit side. Do you see how they totaled all the numbers on the debit side and then they totaled all the numbers on the credit side? And they come up with the balance. The balance is on the debit side. A debit of $31,400. That balance of $31,400 on the debit side just means that the normal balance for a cash account is a debit. Does that make sense? Hang in there with me, guys. They totaled the debits, they totaled the credits, and once they subtracted the debits from the credits, they ended up with a debit, didn't they? So the normal balance for this account is a debit. The difference between the debits, the footings on the debits, which is just purely the totals, and the footings on the credits is the ultimate account balance. The double entry system we talked about shows every single transaction we're going to do is going to have a minimum of two accounts. And those two accounts that we use, whatever we debit, our totals for our debits are going to need to equal our totals for our credits. So every transaction we do, we've got to debit something, enter it, meaning on the left-hand side of the T account, and we're also going to have to take another account and enter a credit, or that means enter it on the right side of a T account. Remember, assets equal liabilities plus owner's equity. Assets have a normal debit balance. Liabilities and owner's equity have normal credit balances. All that means is on the right-hand side of the T account. Okay? So, if a debit increases assets, do you remember seeing on that slide that cash had a normal debit balance? It was on the left-hand side. if a debit, keying it to the left side, increases assets, then credits increase liabilities and credits increase owner's equity, because assets have to always equal liabilities plus owner's equity, okay? If credits decrease assets, okay? Remember how we had a debit balance and we had a credit balance, and the net balance, a debit total and a credit total in our cash, and the net balance was a debit balance? If credits decrease assets, then debits must also decrease liabilities and owner's equity. Hang in there with me. So, let's look at this. Remember always, assets equal liabilities plus owner's equity. The left-hand side of an asset account, the debit side, increases assets. The credit side decreases assets. But look over at liabilities and owner's equity. Do you see there that the credit side increases liabilities and increases owner's equity? And the debit side decreases liabilities and decreases owner's equity. Withdrawals and expenses are going to be deductions from owner's equity. So transactions that increase withdrawals or expenses ultimately decrease our owner's equity, don't they? We're using up owner's equity. So as you see here, for now, we're going to show assets equal liabilities plus owner's equity. When we credit the capital account, we increase owner's equity. When we credit our revenues account, doesn't that increase owner's equity? Revenues increase equity. But when we take away, when we withdraw money, doesn't that decrease our owner's equity? Likewise, when we pay expenses, we're going to decrease our owner's equity. So hang in there, guys. So the normal balance is really the one that's going to increase that specific account. So remember again, a debit just means left. A credit just means right. But for assets, a debit, which means left, increases assets. A credit, which just means right, increases liabilities and owner's equity. Remember, assets equal liabilities plus owner's equity. So let's look here. Assets, to increase the asset, we're going to debit it. The normal balance on assets is a debit balance. For liabilities, to increase a liability, we're going to credit it. And the normal balance on a liability is a credit. Owner's capital, when we increase our capital account, we're going to credit it. And the normal balance on a capital account is a credit. Withdrawals, when we increase our withdrawals, we're going to debit withdrawals, aren't we? We debit our withdrawals to increase it. But think about it. If our withdrawals get increased, it ultimately reduces our capital account, doesn't it? So as you can see, if withdrawals are part of the capital account, when capital increases, it gets credited. Withdrawals decrease it because they're getting debited on the capital account. In the same respect, when we increase our revenues, we credit it. And if we show revenues to be part of our capital account here too, when we increase revenues, we're also increasing our capital, aren't we? Our expenses have a normal debit balance. As we increase expenses, we debit them. But if we show our normal balance is a debit, when we increase our expenses, we're ultimately decreasing our capital balance. Remember when we did an income statement and we showed our income minus our expenses equaled what? Net income. Remember how we took that net income and increased our capital balance? Didn't we? What we're doing right now is we're just breaking down that net income, and we're showing our revenues are an increase to our capital balance and our expenses are a decrease. The net effect would be net income, which would still ultimately be an increase. Okay, hang in there with me, guys. So for right now, our owner's equity is going to consist of our owner's capital, and it's also going to consist of our withdrawals. Remember that owner's equity statement? How we subtracted withdrawals? And then remember we took and added net income? But really net income consists of increasing revenues and subtracting expenses, doesn't it? To ultimately give us our net income. So all of these accounts ultimately play out into the owner's equity. Troy, did you have a question? Okay, I'm sorry. So we've got this thing called an accounting cycle. This accounting cycle is this process we do over and over again that basically helps us measure and communicate all this information to those end users. So this accounting cycle is going to start by analyzing transactions and then recording the transactions. We're going to then do something that's called posting to the general journal entries to the ledger and preparing a balance, trial balance, adjusting accounts to come up with what we call an adjusted trial balance, ultimately preparing financial statements, and then closing the accounts. So what we're doing here, we've got business activities. We're going to kind of analyze them. We're going to record them. We're going to post them, adjust the accounts, prepare a balance, close them, and ultimately prepare financial statements that we give to the users so we can start this process over again and again and again. So let's look at this one, and then after we do this one, we're going to jump to the exercises in the book and do some of those. So this says here, you're given the following list of accounts with dollar amounts. We're going to insert the account title at the top of the corresponding T accounts and enter the dollar amount as a normal balance in the account. Then we're going to show the accounting equation. So we've got a list of accounts with dollar amounts. We see the first one that says D. Logan Withdrawals. What account is this? The withdrawal account, isn't it? Withdrawals have a normal, what kind of balance? A debit. They have a normal debit balance. Why? When you have a withdrawal, you're going to debit that balance. So as it increases withdrawals, it ultimately is going to decrease your capital or your equity in the business. So what we're going to do, the D. Logan Withdrawals has a debit balance. If we look at accounts payable, it's a liability. What is the normal balance on a liability? Remember, debit means left and credit means right. What is the normal balance on a liability? A credit. So we're going to put that $200 on the right-hand side of the accounts payable T account. Next, we have something called wages expense. Wages expense has a normal debit balance. As we increase an expense, we debit it. Now think about it. Increasing expenses ultimately decreases our owner's equity, doesn't it? And if owner's equity has a normal credit balance, when we show expenses, we're going to be decreasing our capital, which means debiting that wage expense. Cash is an asset. What is the normal balance of a cash account? A debit, a left side. So we're going to put cash of $625 as a debit on the left-hand side. Then we have an account called D. Logan Capital, $400. Capital accounts have normal, what kind of balances? Credit balances. We're going to show D. Logan Capital as a credit over here of $400. Then we've got one more. Fee revenues. Revenues increase our capital account, so that means they're going to be a credit account, a credit balance also. So we're going to go over here and show fee revenues as a credit of $250. So remember, again, our assets have to equal our liabilities plus our owner's equity. Let's look at this. Our assets equal, we only have one account that's an asset, cash, $625. So our assets equal $625. Assets always equal liabilities plus owner's equity, don't they? How much is our liabilities? $200. And our owner's equity is going to be a combination of $400 minus $75 plus $250 minus $150. Ultimately, $425. Do you see our assets of $625 equal our liabilities of $200 plus our owner's equity of $425? Or assets of $625 equal liabilities and owner's equity of $625. So what I want to do is take a second. Let's pull up an example. It's the best way to learn. So let's look at, it's around page 70 something. Let's start with SE1. Tell whether each of the following accounts is an asset, a liability, a revenue, an expense, or none of these. Accounts payable. Who wants to take that one? Accounts payable, liability. Supplies, asset. Withdrawals. Is it an asset? It's none of them, is it? Good. It's owner's equity. Isn't it part of owner's equity ultimately? How about fees earned? Yes. Supplies, expense. Accounts receivable, unearned revenue. it's a liability, and we're going to talk about that. There's one account that doesn't have the word payable after it. That's a liability. Unearned revenue. Troy gives me $1,000, but I didn't earn it yet. I have a future obligation, don't I? I received the money, but I haven't done the work yet. What about equipment? Asset. Awesome, guys. Now, unearned income would be when Troy writes me a check and hands it to me for $1,000 to represent him in an audit, but I haven't even done anything yet. So I receive his money, but I haven't done the work. So I would show $1,000 as cash, and I would, as an increase in an asset, and I would increase my liability for unearned income because I haven't done the work. Once I complete the work, I no longer owe him. I can reduce my liability and then show revenues. Okay? So let's look at SE2. Let's tell how the concepts of recognition, valuation, and classification apply to the transaction that follows. Do you see our T account for cash shows a credit on June 1st, and then it shows a debit on June 1st to supplies of $1,000. Recognition is the when. What's the when here? Valuation is the how much? $1,000. Classification is it's an increase in supplies because it's a debit. It increased supplies and we decreased cash. Does that make sense? Okay. So let me go back here to our PowerPoint. Okay, so now we're going to now start talking about analyzing these transactions. We kind of just analyzed a transaction as far as understanding the valuation, the classification, and the recognition. Okay, so now we're going to look at how we analyze business transactions. Business transactions get analyzed by what we call source documents. They're going to be invoices, they could be receipts, they could be checks, they could be contracts, they could be bank loan agreements or contracts. Those are the source documents. That's the original documentation that came from creating that transaction. So source documents are what we need in order to create transactions. We need to have something tangible to prove what we're going to do. A journal entry is a notation that records a single transaction in a chronological accounting record known as a journal. Each entry has to be in a specific form. This specific form you're going to see this first class of accounting you take until you are done. Even if you get a doctorate in accounting, you're still going to use journals. Okay? this transaction, we always start with the date. The date is recognition. Then you're going to have the account we're debiting. Then we'll have the account we're crediting, and that is classification. Then we're going to show the amount we're debiting and the amounts we're crediting, and that is valuation. Do you guys see kind of how it all is fitting together? So, we're going to analyze a transaction here. On July 1st, Joan Blue invests $40,000 in cash to form Blue Design Studios. Okay? Recognition? July 1st. Classification? That's what we got to figure out, isn't it? That's the harder part, guys. How much is the valuation? $40,000. Let's think about this, guys. If Joan Blue invests $40,000 in cash, what do we know we're going to do? What's going to increase in this transaction? Cash, we know is going to increase, don't we? Now, this might be a little tricky, but she is investing. She's the owner. She's investing her own money into this new business. Yes. So what's happening here? We're going to increase cash with a debit, the left-hand side. We're going to increase our owner's equity account with a credit. If Joan Blue had invested assets other than cash, we would have still increased the asset. It might not have been the word cash, which is the classification. We might have increased automobile or equipment. Do you see what I'm saying? But as we increase an asset, we debit it. As she's investing, she's increasing her equity in the business. So, in this example, we have a T account called asset, cash, and we have a T account called J Blue Capital. Do you see assets have to always equal liabilities plus owner's equity? Our asset here of $40,000 got increased. So guys, we have to have our debits equal our credits, don't we? Do you see how our debits of $40,000 in this case equal our credits of $40,000? So as you see, cash, this is our journal entry. It shows the recognition, July 1st. The classification, cash was increased, $40,000. And J Blue Capital was increased, $40,000. And the valuation is? So, recognition, classification, valuation. This journal entry shows in analyzing that transaction, we're going to take that document of her check getting deposited into the J Blue account or the business. And from that check, we're going to analyze what happened here. So you see, the cash of $40,000, we posted that to our T account. And our equity of $40,000, we posted that to our T account. Economic event that is not a business transaction. On July 1st, Joan orders. She calls up on the phone and says, I want $5,200 of office supplies. Has a transaction occurred? In this case, they're saying no. Now, I'll tell you, I just ordered $260 of glasses last night from Zenny Optical online. Okay? But for most of us, when you order, what do you have to do right away? You pay. So if I technically did that through a business, I would have had a business transaction. But you see, Miss Blue here and the company, they're in tight. She can just call an order, but they haven't delivered it yet, and she hasn't received a bill. Okay? So, on July 1st, Joan orders 5,200 of office supplies for Blue Design Studio. When an economic event is not a business transaction, we're not going to recognize it. So, for you or me, when if I call Office Max and order $5,200 of supplies, they want my credit card right away. Okay? So I would have had a business transaction. But in this case, they did not tell you that they delivered the goods, because technically they have not delivered the goods. Okay? So,
I would want to subtract just to make sure it's there.
correct. In this case, they're trying to say because the goods have not been received and they have not received a bill yet. Okay, like I received a bill last night on Zenny Studio and I had to pay it before I was going to order it. They just don't trust me to order these glasses. Okay, so here's another transaction, guys. On July 3rd, Joan rents an office for Blue Design Studio. She pays $3,200 for 2 months' rent in advance. Did a business transaction happen? It did. What is the, recognition? July 3rd. What is the valuation? The hardest part is the classification. We do know one. What happened to her cash? It went down. And basically, in this case, we haven't talked about this yet, but she's basically going to increase an asset, prepaid rent. Prepaid rent is an account, and we're going to have prepaid insurance and various types of prepaids, where you've paid something, but you haven't used it up yet. So she paid 2 months in advance of rent. But the rent isn't expensed yet because she didn't use, just due to the passage of time, rent gets used up. She paid it up front. So it's an asset until that month passes and then the next month passes. Okay? This is similar to insurance. If I pay a year's worth of insurance up front, I'll use 1/12 of that amount each month that passes. And then it becomes an expense. Okay? So in this case, Joan rents an office building, pays $3,200 for 2 months' rent in advance. An account classification called prepaid rent's going up, but another account, which is an asset, called cash, is going down. So do you see here? Assets, cash is an asset, it's going down. Prepaid rent is an asset, it's going up. Let's look at this though, guys. Assets will always equal liabilities plus owner's equity. We know in every transaction, debits have to equal credits. Do you see in this journal entry, we debited something? And we also credited something? Do you see? We didn't even deal with the other side here, the liabilities or the owner's equity. We increased an asset for $3,200, and we also decreased an asset for $3,200. But do our assets still equal our liabilities plus our owner's equity? Yes. That before this transaction, our assets equaled our liabilities and owner's equity. And after this transaction, do you see all we did was we increased one asset and decreased another asset? They still balance, don't they? Hang it.
I don't think prepaid rent
it's a prepaid, so it's not an expense yet until the month is gone.
So if it was just rent, then it would be an expense.
Yes, but if we paid 1 month of rent and the month is now gone, yes. In this case, she paid 2 months way up front. So they're trying to help us understand here that an expense doesn't occur until it's used up. An expense only happens with the passage of time. Insurance just happens with the passage of time. You know, if I don't use insurance, do I get my money back? No, it's used up. Okay? Same with rent. So like, let's say this past month I was in my office 2 days. Can I go back to my landlord and say, but I was only there 2 days. I only want to pay $200. No, doesn't work that way. I use it for the availability to have it whenever. And then after August is over, whatever I paid is gone, and the next month is upon me. Okay, so as you see here, this journal entry helps show the prepaid rent was increased $3,200. Do you see our journal entry shows a debit to prepaid rent? And our cash decreased $3,200. Do you see our journal entry shows a credit to cash of $3,200? Here's another one. On July 5th, Blue Design Studio receives the office supplies ordered on July 2nd and an invoice for $5,200. Did a business transaction take place? Yes. What is the recognition? July 5th. What is the valuation? $5,200. What would be the classification here, guys? Supplies get increased, right? And a liability also gets increased. Why? We owe the money, don't we? Perfect, guys. So an increase in assets of office supplies and an increase in a liability of accounts payable. So do you see here our assets got increased $5,200 by debiting them? Our liabilities, called accounts payable, is the classification, was increased $5,200 by crediting it, wasn't it? Do you see the journal entry? Office supplies is an asset. It got increased. The accounts payable is a liability. It got increased. Debits always equal credits. Do you see we have a $5,200 debit and a $5,200 credit? Do you see our assets still equal our liabilities plus our owner's equity? Here's another one. On July 6th, Joan purchases office equipment totaling $16,320 for Blue Design Studio. Joan pays $13,320 in cash and agrees to pay the rest next month. What's the recognition? July 6th. What's the amount? Okay, the what is? $16,320 is the equipment valuation. That gets reduced. And how much is that? Sorry. It's so exciting when you guys get it. Normally, I get.
Well, we get it collectively.
Hey, guys, do you see how it works? Does it help? If that's how we learn, classrooms are great. Because that's my hope. You do feed off of each other. Okay? So, what happens here? Assets, the office equipment, goes up, which means debit, which means left. Another asset goes down, cash, which is credit, which means right. Then we have a liability that goes up, which means credit, right. So look at this. This got a little more confusing, but it still all makes sense, guys. Our debits equal our credits, don't they? Our debit was $16,320. Our credits were $16,320. The 13,2 and the 3. Am I doing that wrong? 16. Okay.
We know what you mean.
Okay. Okay, so do you see our office equipment went up? We debited it. Then we had cash that went down. We credited it. Then we have a liability that went up. And remember, liabilities, when they go up, have what kind of balance? A credit balance. So if you see our journal entry, our debits equal our credits, don't they? Our office equipment went up $16,320, and the way we paid for that was take some cash and use it, and then have a loan. So what we're doing here, we had some entries in our T accounts prior to this transaction, didn't we? And so all we're doing now is posting to our T accounts this new transaction, this new journal entry. Do you see how we took July 6th and we credited our cash from here? And do you see how we took our office equipment, debited it right there, and then our accounts payable credited there? Our debits still equal our credits, don't they? Guys, the trickiest part of this, and thank God for computers, is when I used to have to do this by hand. Do you know how easy it would be to take this $3,000 and I know it's a credit, but I accidentally put it in the debit column? Do you see what I'm saying? And so I spent so much of my time trying to find a mathematical error or a human error instead of letting the computer do it for me, because we didn't have them back then. Here's another one. On July 9th, Blue Design Studio makes a partial payment of $2,600 for the amount owed for the office supplies received on July 5th. Do you remember how much in office supplies did they receive? Or was it $5,200? $5,200. $5,200. But she paid $2,600 of it, right? So is our accounts payable totally done? No, we still are going to owe some, aren't we? So let's look here. When we make a partial payment of $2,600, when did this occur? Recognition? How much? Valuation? Classification? No, supplies happen when we got them. Cash goes down, which is a credit. What else is going down? The liability is going down, and when a liability goes down, it's a debit. So do you see here? We're showing accounts payable goes down, it's a debit of $2,600. Cash also is going down, which is a credit. Remember, a normal cash balance is a debit balance. But when it goes down, you credit it. Okay? On the opposite end, A normal liability has a credit balance. But when it goes down, what do? You debit it. Let me tell you about when you go to a bank and you put money in and they say we credited your account. Okay? Let's pretend we're the bank. Okay? We own the bank. You drive up. You give me a check or cash for $2,000. I'm the bank, guys. What am I going to do with this $2,000 in the bank's records? What is this $2,000? Cash. The bank's cash is doing what? Increasing. But how much the bank owes you? Your money is a liability to the bank, isn't it? So when they say they credited your account $2,000, do you see their liability went up? They owe you that money back. Does that make sense why they say they credited you? You're thinking that's good for you. They're telling you the bank increased their cash, but they also had to increase their liability, your account. Make sense?